Hello, my name is Jean-Jacques van Helten and I am a visiting fellow at the Florence School of Banking and Finance at the European University Institute here in Florence. And today I want to talk to you about changes in risk management within financial services. I will consider three main aspects. Firstly, changes in management of risk from what we can call sets of rules to codes of conduct following the global financial crisis some 10 years ago. Secondly, the role of the regulator and supranational supervisors, in other words, the European institutions like ECB and ESMA and the like, on risk governance within the European Union. And finally, what's next for risk management in the EU as financial services grapple with increasingly complex and wide-ranging ranges of emerging risks like climate change and the like. Now, the global financial crisis that began in 2007 has impacted, in my view, the financial landscape globally and in some respects has also changed it irrevocably. More than anything else, the global financial crisis, you may recall, revealed a pattern of excessive risk-taking. Yet today, almost universally, risk governance is now more central to the management of financial institutions and has much more senior management and board attention placed on it than was the case prior to the crisis. So what are the main changes? Well, before the global financial crisis, risk functions were mostly focused on credit risk, underwriting processes, assessments of credit worthiness, developing cash flow models, and the like, and considering products, country, and industry concentrations. Also, most of the risk teams were perceived by the business, front lines in particular, as being more preventers of risk than enablers of risk. True risk takers, as one of my colleagues once pointed out, had neither formal risk framework and processes nor appropriate controls in place to report exposures and levels of risk taken. Overall corporate governance at that time was not well documented, with clear decision-making processes, and delegations and accountabilities were not sufficiently understood. Also, before the crisis, risk, and I know this from personal experience, was a relatively isolated function. And fingers were often pointed at risk as being a function which always came up with the worst-case scenarios, doomsayers almost, and concerns around liquidity and underlying complexity of structures like CDOs that management thought would never happen anyway. Nonetheless, despite these inauspicious state of affairs, the one area of banking, in my view, that has changed most post the global financial crisis has in fact been the governance and management of risk in banking. In 2008-2009, no one would have thought that risk functions could have changed as much as they have in the last 10 or more years since the crisis. However, let us be under no illusion that these changes in risk management in banking were coordinated, at least initially, within the banks themselves. There was no Damascene conversion, no profound paradigmatic shift in the management of control and oversight from within the industry, at least initially. This then brings me to my second point, namely the role of the regulators and supervisors in bringing about these changes in risk management. Within the EU, the regulatory reform after the global financial crisis was more than anything concerned with internal bank processes and governance, not just in the context of supervision, which we call microprudential regulation, but also in forward-looking resolution laws, macroprudential regulation. This development was in various distinct stages, such as the rollout of CRD4 and BRRD, and then of course most recently the European Commission's publication of the banking practice last year in October 2021, which finally aims to complete the post-financial crisis agenda in the European banking sector as part of the Basel IV implementation. These and earlier regulations have in turn triggered a long overdue and ongoing changes in risk management in the banks themselves, requiring much more detailed as well as much higher standards for risk reporting. In seeking to establish best practice principles across the overarching governance and infrastructure, supervisors focused on risk data aggregation capabilities, risk reporting practices, stress testing as a major supervisory tool, and finally, risk appetite statements. Now, when you look at the demands of the various regulators, I can see an increasing move from very qualitative kinds of supervision to much more quantitative approaches. There's still a reliance, but increasingly less so, on on-site supervisions by the regulators and massive data collection. Deep dives, specific reports, requesting huge amounts of information in a very short time, and then issuing a suite of recommendations, often based on comparative analyses of other banks, to implement it at an equally short time. This brings us to a point where sometimes the banks are spending, in my view at any rate, much more time answering regulatory questions than managing the risks. Nonetheless, banks have invested heavily in strengthening their risk cultures and have involved boards much more widely in their key strategic decisions. The post-financial, crisis-regulated banking landscape, principally led by Basel III and Basel IV, has dictated that the banks assess and carefully review their risk frameworks, establish firm-wide taxonomies, and assess the risk-reward impact of strategic decisions on day-to-day business activities. What was once, pre-crisis, a highly regulatory and compliance-driven function led by quantitative assessments has now become much more proactive participant in holistic, top-down business strategies underpinned by regulatory risk and control monitoring processes. In summary, central to the architecture of risk control is the requirement to link bank risk appetite with business models, budgets, and strategic decisioning. Which brings me to my final point. What are the next challenges for risk management within the finance sector? Now, we've seen enhancements and changes to the architecture of control, and they've been mostly driven by regulatory landscape and legislative obligations. Risk leaders, I'm afraid, I probably have to put my hand up for that myself, frequently use the excuse of regulatory obligations to drive change or to enhance a firm's risk management processes. Risk assessments are probably still too empiric. The embedding of risk appetite into the businesses is not fully achieved everywhere, and it demands a constant focus by risk management. As one of my colleagues once pointed out to me, I think completing risk registers rather than identifying processes and associated control weaknesses can also lead to an inability to drive effective risk management and embed decision-making. And we've seen that in some of the recent risk scandals in one or two of the Swiss banks. Interestingly, within the context of the banking union within the European Union, the complexity of cross-border groups is also a growing concern, with multiple jurisdictions and legal entities and business lines. And if you have isolated lines of defenses in different countries, that remains a risk in terms of fully functioning and centrally managed risk management control. In many firms, the risk management function is headquartered and thus far from the front line, particularly in a cross-border context, to be able to manage this effectively. And that then runs into the risk of actually removing real accountability from the business and doesn't help to integrate and really embed risk management in the business, core processes and decisioning. Ultimately, in my view, risk is about ethics, it's about conduct, it's about lessons learned, and that's really, really important. It's also important to bear in mind that there is a risk and conduct culture, and we often take that for granted. But we can't simply assume that it's there within the bank just because they say it is. And that's something that we may well concentrate on at a future.